can see what it did to gold. You may not be able to see it here, but because of the rendering, but I'll show you what we're talking about here. Gold, these are 15-minute charts. An hour after, dipped all the way down to here, rebounced, and then retested it. So gold was the most aggressive example of selling that could not find buying. Silver, while it wasn't the most aggressive, net was the most aggressive in the 45 minutes afterwards. So somebody got a bad fill on their selling, or maybe somebody panicked and had to sell and the exchange was closed, so they went to the OTC market.
Gold and silver markets are highly interdependent, and brief disruptions in futures or spot trading can cause sharp price swings and temporary market fragmentation. Vince Lanci, a market analyst, explains that recent price disruptions in the precious metals market reflect the underlying market structure rather than any intentional manipulation. When the CME futures platform went offline while spot metals continued trading, the interdependency between the two venues became apparent. Futures typically drive incremental buying, while spot and OTC markets handle a large portion of selling flows. With futures offline, the usual balance between buying and selling flows was disrupted, causing spot prices to dive sharply before eventually normalizing. He emphasizes that intermediaries, such as bullion banks and major liquidity providers, operate across both futures and spot markets to hedge and offset flows. When one venue is unavailable, these intermediaries cannot perform their normal function, leading to order imbalances and poor fills. The recent event demonstrated this in real time. Selling continued in the OTC market, but the absence of corresponding buying from futures created temporary dislocations in prices. Lanci highlights that the episode also exposes the fragility of centralized price discovery systems. While redundancies like the CME Aurora Center exist, the outage shows that even robust fail-safes can be stressed, especially in unusual conditions such as holidays. The result is temporary market fragmentation, where isolated price movements occur, revealing that the system can split into islands under stress. This event serves as a reminder that the global metals market operates effectively only when all its parts are coordinated, and any disruption, however rare, can have immediate and pronounced impacts on pricing. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
This reflects the market structure rather than any theory about intent. When the CME futures complex went offline, but spot metals continued the trading, the price action exposed the degree of interdependency between the two venues and the interdependency in metals of the bullion market, the bullion dealers, to trade both venues. So on the left-hand side, you see silver futures. Silver futures. On the right-hand side, you see a representation of spot, not the true spot market, but CFDs, which trade out of Europe. The left-hand side, when the futures closed, they closed. The right-hand side, the market, the silver market, had a very deep dive immediately thereafter. And then it reorganized itself, and it seems to be normalizing. But the deep dive after the gray line is what I'm talking about here. It'll be more obvious in gold, but I want to leave silver up here for the moment. If you review the charts from this window, you will notice a pronounced dip in gold during the outage. This is silver. Let's go to gold since I'm talking about it because it's worse. All right. The simple interpretation is structural. A meaningful share of the incremental buying in precious metals originates from the future side, while a meaningful share of incremental selling flows through the spot and OTC market. When the futures market suddenly disappeared, the buying flow that normally meets OTC selling, where the bullion banks play, suddenly disappeared. Okay? The selling still arrived because the OTC market has its own origin order flow, but the buying was not present. So the selling, again, still arrived, but because the OTC market was open, the buying that normally offsets it was unavailable. With no counterparty to absorb the flow across exchanges, prices moved lower. This is not a conspiratorial argument. It is an illustration of how the ecosystem actually works. People familiar with this program and with this newsletter know that we talk about EFPs a lot. The EFP is an example of this. The futures market is where a large portion of the speculative and directional flows originate. The spot and OTC markets reflect physical related, commercial, and arbitrage activity. Banks and major liquidity providers operate across both venues and use each market to hedge or offset flows from the other. Now, when one venue goes dark, the intermediaries who knit these markets together cannot perform their normal function. Last night demonstrated this clearly. Without the futures side operating, the OTC side became temporarily order imbalanced. The intermediaries who usually bridge the spread between both markets were unable to do so because one leg of the bridge was offline. The result was a short window where spot prices traded in isolation, a real-time example of market fragmentation. And a lot of the selling got bad fills. This is an important lesson about the structure of the modern metals market. It is globally connected when everything is functioning, but that connectivity is now fragile. A single failure at the electronic exchange level can cause the global pricing mechanism to split into separate islands. The fragmentation, even if temporary, is a form of deglobalization in practice, a sign of how reliant the system has become on centralized price discovery and how quickly it can fracture when that center experiences stress. This should be taken seriously. It was a rare event, but it exposed one of the most important truths about today's metals markets. The system works only when all the components work together. And they will not work together anymore in this geopolitical environment. So, spoofing aside or shutting down a market to get things organized aside, very dangerous stuff to happen. And extremely, I can't tell you how rare this is. All right. The CME built something called the Aurora Center for co-location. I mean, redundancy upon redundancy. This shouldn't happen. There are 3 or 4 fail-safes before it goes out. So holidays may have had something to do with it. But regardless, you can see what it did to gold. You may not be able to see it here, but because of the rendering, but I'll show you what we're talking about here. Gold, these are 15-minute charts. An hour after, dipped all the way down to here, rebounced, and then retested it. So gold was the most aggressive example of selling that could not find buying. Silver, while it wasn't the most aggressive net, was the most aggressive in the 45 minutes afterwards. So somebody got a bad fill on their selling, or maybe somebody panicked and had to sell and the exchange was closed, so they went to the OTC market. Anyway,
Vince Lanci explains that the recent CME Globex outage, while appearing to be a routine technical failure such as cooling issues or hardware glitches, exposed the fragility of a system central to global financial markets. CME Globex is one of the most relied upon and redundantly engineered electronic trading platforms, and when price discovery stops, liquidity quickly evaporates, causing fragmentation. The outage highlighted how essential continuous connectivity is, particularly for precious metals like gold and silver, where futures and spot markets are deeply interdependent. Without the normal flow of buying and selling, spot prices experienced sharp reversals and poor fills, demonstrating how even robust systems can struggle under stress. Lanci also emphasizes the broader strategic and geopolitical implications. Rising Asian exchanges, such as the Shanghai Futures Exchange and Shanghai Gold Exchange, are increasingly competing for influence, and any disruption in CME's platform undermines confidence in Western market leadership. The outage illustrated how futures liquidity supports spot market stability, as seen in the sharp pullback in silver. It also reinforces a shift in global markets from centralized price discovery toward competing regional infrastructures, signaling a transition from globalization to regional realignment where multiple centers now play a role in defining prices. Let's get back to the interview.
On the surface, this looks like a straightforward technical failure. Cooling problems happen in data centers. Hardware fails. Software misbehaves. In most industries, that would barely make news, but this is not, quote, most industries. This is CME Globex, one of the most relied upon and redundantly engineered electronic trading systems on the planet. It is supposed to be robust, resilient, and always available, and more importantly, Global markets depend on it. Financial markets function because prices are continuously broadcast. When price discovery stops, liquidity quickly becomes illiquidity. Markets seize, information flow slows or fractures. The entire structure of modern globalized trading depends on tight, uninterrupted synchronization. When that breaks, the system stops looking global and starts looking fragmented, which is in many ways a mirror of what's happening in the world right now. CME has only experienced a few major platform failures in the modern era. 2014 and 2019 are the big precedents, and those occurred in a world where CME had no serious competitors. This has changed. The Shanghai Futures Exchange and the Shanghai Gold Exchange, both separate exchanges tied together, have been gaining ground rapidly in metals. Exchanges today do not simply match trades. They compete for the right to define the price the world references. The old quote, turn the machines back on line from Trading Places is now a real geopolitical business analogy. So beyond the immediate technical failure, there is a strategic business issue. This is the first point. This outage exposes vulnerability, whether the root cause was hardware, software, a vendor problem, or a holiday weekend scenario. The end result is the same. It shows that even the most centralized and respected price engine in the West can go dark. And that is exactly the kind of incident that encourages rival exchanges to accelerate their own ambitions. Any business that depends heavily on its online infrastructure, Amazon, cannot afford downtime. This is not different. CME's electronic platform is the business. When it goes offline, the brand takes a direct hit. In a competitive landscape that now includes rising Asian futures markets, the optics are poor and the timing compounds the problem. There is also a second line of interpretation, not a conclusion, but a concern some traders and analysts voiced unofficially. At the moment the outage began, precious metals were exceptionally strong. Silver was at all-time highs. Platinum was surging. And on that same day, China launched its new platinum futures contract, which opened strongly and drew considerable attention, as new contracts are wont to do. Then, once Globex went offline, silver sharply reversed in the spot market, giving back much of its earlier gains. To traders watching closely, it looked as if the physical market price struggled once its futures contract vanished, exposing how interdependent the two markets have become. One veteran trader put it bluntly, perhaps too bluntly, when he suggested that, quote, someone pulling the plug on the COMEX until they could get that paper book that they have in order, referring, I think, to the rehypothecation cross orders. That's speculation, and it should be treated as such, but it captures a sentiment that arises whenever a key pricing venue fails during critical market moments. Robinhood, for example. Okay, smaller exchanges in crypto that shut down when the market gets too strong or too weak. History has its own analogs, such as the London gold pool in the late 1960s, when coordinated efforts were used to steady a market under stress. Cannot emphasize enough that if people are talking this way, then trust is being eroded in the institution that directs that has such an important part in our system. Whatever the underlying cause, the optics are not good for CME. They are not good for Western market leadership more broadly. Coming after the LBMA's liquidity strains in physical metal and amid rising prominence of the Shanghai exchanges, SGE parallels LBMA. Shanghai Futures Exchange, SHFE, parallels COMEX, which is now a subdivision of Globex. The outage feeds a narrative that the Western pricing structure is looking increasingly fragile while the Eastern infrastructure is expanding. In that sense, this may be more than just a cooling system failure. It's another sign of a world moving from globalization toward regional realignment, and a world where price discovery is no longer defined by a single center, but by competing ones. Mercantile, if you will. There's one final observation from last night that we would like to draw your attention to, having studied the tape closely. And let's bring up a chart to that effect first.
The CME Globex outage highlights the structural fragility of gold and silver markets, demonstrating how disruptions in futures trading can trigger sharp price swings and temporary fragmentation across spot and OTC venues. It underscores the critical interdependence of liquidity flows, where the absence of futures buying can leave the spot market unable to absorb selling pressure, resulting in significant price dislocations. Beyond the immediate technical issues, the event illustrates broader shifts in the global precious metals landscape as rising regional exchanges, such as those in Shanghai, increasingly challenge centralized Western platforms. This trend signals a move toward a more regionally diversified and competitive market for gold and silver, where price discovery no longer relies solely on a single center but instead reflects a network of interconnected venues that must function together to maintain stability. How might the growing influence of regional exchanges and liquidity interdependence impact the stability and price discovery of gold and silver markets in the future? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.